Today, banking on a relief rally. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and problem news with a distinctively Australian flavour. Well, US stocks ended higher on Monday as gains from banks and also a rebound in market-leading tech shares supported a broader base rally, following Wall Street's longest streak of weekly declines since the dotcom bust more than 20 years ago. As the US Federal Reserve rushes to contain decade-high inflation, investors are worried that overly aggressive monetary policy tightening could tip the economy into a recession. Those fears had driven the S&P 500 Bank Index down 21.5% this year. But interest rate-sensitive banks jumped 5.1% after the largest US lender, JPMorgan Chase, raised its current year interest income outlook. In fact, those stocks surged 6.2% and shares in other big US banks rose sharply too. It feels like a relief rally more than a fundamental change in investor sentiment, said Oliver Pursche, Senior Vice President at Wealthspire Advisors in New York. Investors as a whole feel like there's another shoe to drop, and they're probably right in the short term. So JPMorgan Chase lifted its guidance on annual performance. The country's largest lender said it expects net interest income, excluding from markets, of $56 billion in 2022. Its earlier forecast that figure would reach a couple billion more than $53 billion in 2022. That's up from its $50 billion outlook back in January. Investors are keeping a close eye on the prospects for banks to earn more from net interest income. That's the difference between income from loans and interest paid on deposits and other funds, as they tend to benefit from higher interest rates. JPMorgan scheduled the conference after it surprised investors in January when it said it would allow expenses to increase 8% or $6 billion. Now, the bank is a leader in many of its businesses and it's been more profitable than its peers, but success has raised doubts among investors about its ability to grow profits further. JPMorgan Chief Executive Officer Jamie Dimon and other executives spent much of the day trying to reassure investors that expenditures on technology, new products and marketing were necessary to stay ahead of competitors and that it would pay off long term, but have to say some analysts remain unconvinced. The bottom line is that you are still spending a lot of money this year, analyst Matt O'Connor from Deutsche Bank told Dimon. Are you doing too much all at once? Dimon, known for his straight-talking style, bristled. We just spent the whole day trying to answer that question. He responded, adding, we showed you the opportunity. For 2023, JPMorgan expects its investment spending growth rate will moderate, but its 2022 expense forecast was kept unchanged at $77 billion. An executive said JPMorgan is spending to hire bankers and to recruit new customers in wealth management, commercial lending, and business payments, both in the United States and increasingly abroad. By not holding the annual conference last year, the bank has gone too long without fully explaining its strategy, said Dimon, who pledged to hold the conference again next year. And he said current threats to the economy are serious, but that a bust is not inevitable, as it was before crashing house prices sparked the financial crisis of 2007 to 2009. Charge-offs of bad loans are estimated to rise to pre-pandemic levels over time, but not until after 2022, the bank said, because of strong consumer and business balance sheets. And the company said its target for a 17% return on tangible capital equity, that's a key metric, which measures how well a bank is using shareholder money to produce profits, may be achieved in 2022. But recession risk was, quote, the elephant in the room, and that was acknowledged by Marianne Lake, the co-chief of Consumer and Community Banking. And Christopher Grisanti, Chief Equity Strategist at MAI Capital Management, said that JPMorgan's news showed that investors had been too pessimistic on banking stocks. Banking businesses are generally pretty good. Credit concerns are low, at least for the moment, and the net investment margin remains pretty healthy, he said. The market doom and gloom is overstated. Of course, banking stocks have been under pressure recently as fears about a recession offset expectations for higher interest rates as the Federal Reserve is set to step up the pace of monetary policy tightening. And the positive outlook from JPMorgan sparked a rally in several banks, including Citigroup, Wells Fargo, and the Bank of America. All three major US stock indices advanced between 1.6 and 2%, with the heaviest boost coming from rebounding mega-cap tech stocks, including Apple and Microsoft. Last Friday, of course, the S&P 500 closed 18.7% below its record closing high, reached just on January the 3rd. And of course, if the benchmark index closes 20% or below, it will be confirmed to be in a bear market, although with all of these things, it's a bit relative, really. 19.9 versus 20.1. Is it that far apart? It's worth saying, I think, that markets have been worrying in recent weeks about persistently high inflation and aggressive attempts by the Federal Reserve to rein it in while the global economy copes with fallout from Russia's invasion of Ukraine. Today, it would appear the market is less fearful over the inflation factor and the Fed being able to orchestrate a soft landing, so to speak, said Chuck Colson, Chief Executive Officer at Horizon Investment Services. But the bias is still to the downside, Carlson added. The Dow Jones Industrial Average rose 1.98% to 31,880. The S&P 500 gained 72 points, or 1.86%, to 3,973, and the Nasdaq Composite was 1.59% higher to 11,535. Now, it's worth noting that the Fed will give investors a hint of its state of mind on Wednesday when it releases minutes from its latest policy meeting. And other economic indicators this week might lend further support to the notion that inflation peaked in March and show whether high prices have hurt consumer spending power. And in passing, the first quarter reporting season is nearly now finished, with 474 companies in the S&P 500 posting results. Interestingly, 78% beat expectations. Looking ahead, current quarter pre-announcements are generally pessimistic, though, with 59 negative projections and 32 positive, compared with the year-ago quarter's 37 negative and 52 positive. Looking at specific shares, those of VMware surged 24.8% following reports over the weekend that chipmaker Broadcom was in talks to acquire the cloud service provider. Broadcom dropped 3.1%. Our one concern is that the potential that regulators block the deal. While we don't see the business overlap that traditionally has created regulatory scrutiny, we would argue such overlap doesn't exist with the proposed acquisition, said Wedbush. US-listed shares of Chinese ride-hailing app Didi Global dropped 4% after shareholders voted in favour of delisting from the New York Stock Exchange. The dollar index fell on Monday, while the euro rallied after the European Central Bank indicated a move from negative interest rates and riskier currencies gained ground, along with equities. ECB President Christine Lagarde said in the blog post that the bank was likely to lift the euro area deposit rate out of negative territory by the end of September and could raise it further if it saw inflation stabilising at 2%. The euro's rally came as the dollar fell broadly after already selling off last week. Eric Nelson, the macro strategist at Wells Fargo, said we're seeing more optimism around global growth, European growth, Chinese growth, UK growth, and a little bit less optimism about US growth. So the growth divergence theme is really a big thing and moving out of favour for the dollar. The euro was the biggest gainer, last up 1.13% at 1.0687, having risen as much as 3.4% from its multi-year intraday low of 1.0349 just on May the 13th. The US dollar index, which had hit a two-decade high of 105.01 on May the 13th, was last down 0.82% at 102.09. Investors are still interested in the greenback, but foreign currency pressure to the upside has created a bit more of a headwind for the US dollar, said JB McKenzie, Managing Director of Futures and Forex at Charles Schwab. In particular, McKenzie pointed to the euro's rise after the ECB indication that it would become more hawkish. Everybody else has been hiking interest rates. The ECB has been the last one to do that, so that was what put pressure on the euro. Now, all of a sudden, you're starting to hear that they're going to be changing their policy route, McKenzie said. Whether the dollar is taking a breather or keeps falling will depend on news from the US Federal Reserve, according to McKenzie, who will be watching closely for policy clues from those minutes coming out this week from the recent Fed meeting. The greenback has already soared this year, but with expectations for repeated rate hikes already priced in, Wells Fargo's Nelson said it may trade sideways for some time. Last week, speculators' net long positions on the US dollar slipped after hitting their highest level since late November. In the previous week, the Australian dollar, by the way, which initially showed a muted reaction to the victory for the Labour Party in our election at the weekend, was up 0.77% at 71.06. And meanwhile, the Swiss franc was gaining against the dollar after Swiss National Bank governing board member Andrea Mescher said in an interview published on Monday that the bank will tighten monetary policy if inflation in Switzerland remains persistently high. The dollar was last down 0.89% against the Swiss franc after hitting its lowest level since late April. Sentiment around China also helped riskier currencies because Shanghai is edging out of a pandemic-related lockdown, and an unexpectedly big rate cut in China last week also reassured investors. And China will broaden its tax credit rebates, postpone social security payments and loan repayments, roll out new investment projects, and take other steps to support the economy, according to Chinese state television, quoting the cabinet on Monday. In fact, the yuan had its best week since late 2020 last week, and in offshore markets on Monday it firmed to 6.704 per dollar. That's the strongest since early May. Energy stocks, meanwhile, rose more than 2% as oil prices wavered between gains and losses despite growing expectations for a boost in energy demand as Shanghai prepares to reopen after a 2-month COVID-19 lockdown. West Texas Intermediate crude for July added 0.5% to 110.81, and Brent crude was at 113.33. So shares like Schlumberger, APA and Coterra Energy were all up sharply on the day, with the latter rising by more than 5%. Now, talking about the Australian market briefly, rising cases of the coronavirus in Beijing dampened Australian and Chinese shares and did revive investors' fears about Chinese growth, and to an extent that offset any rally relating to the election. So yesterday, the ASX gained only 3.3 points to 7,148, a gain of less than 0.1%. So once again, the truth is our local markets very much react to what is going on over there. But it's worth noting that commodity prices continue to look a bit weak, and that, of course, will have a little bit of a negative impact on the local markets. So I suppose the question that everybody's now asking is whether this is a fundamental change in the markets or simply a relief rally. Well, at the moment, the only evidence that I can see is suggesting merely a relief rally. And I still think the market has got further to go to the downside before we find a firm footing. And that is very much connected to where interest rates are going to be going over the next few months. Now, if you're buying your home in Sydney's contentious market, You don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.